What if you could get the investment playbook from Warren Buffett, but not the billionaire icon we know today? I'm talking about a young, hungry partnership manager in his early 30s. Well, that's exactly what we're doing. We are going all the way back to 1963 to decode the core philosophy he laid out for his very first partners. So let's get into it. Right off the bat, Buffett just shatters the biggest myth in all of investing. He looks his partners in the eye and says, "Look, I can't predict the future." I mean, think about that for a second. This immediately begs the question, right? If the world's greatest investor isn't trying to predict the market, then how on earth does he consistently win?
Well, the secret starts with the foundation. Before he even hints at what he's going to buy, he lays out this crystal clear set of non-negotiable ground rules. And this isn't some fluffy mission statement. It's a contract for how to think about money and investing. Okay, so rule number 1, manage expectations. Big time. Buffett makes it incredibly clear. We are not going to make money every single year. The real benchmark for success isn't just being in the green. It's about outperforming the Dow Jones, that big index of 30 major U.S. companies. And he says you can't even judge him for at least 3 years. He's demanding patience from day one, and he's completely shifting the focus to long-term relative performance. So, with those rules set in stone, Buffett then does something brilliant. He distills his entire investment philosophy down to 3 simple, incredibly powerful promises. This is the heart of his code, really, the A, B, and C of his whole approach.
And here it is. First, discipline. He says we're going to choose investments based on their real value, not because they're popular. Second, safety. The number one goal is to avoid losing money permanently. And third, and this is huge, true accountability. He says, my family and I have pretty much our entire net worth invested right alongside you. Now that's what you call skin in the game. Let's just zero in on that second promise for a minute, because it is the absolute cornerstone of his whole philosophy, the margin of safety. This is not just some catchy phrase, it's a discipline. It's this built-in admission that, hey, the future is uncertain and we're probably going to be wrong about some things. So the goal is to build a massive buffer between the price you pay for something and what it's actually worth. And this quote just nails it. It perfectly illustrates what he means. Your profit isn't made when you sell. It's locked in the day you buy. If you can buy a business for 50 cents that you know deep down is worth at least $1, you don't need some booming market or a brilliant exit plan to win. Even a mediocre sale at, say, 75 cents gives you a fantastic return. So the philosophy is crystal clear. Buy cheap with a margin of safety. But the big question is, where did he actually go to find these opportunities? Well, he had a specific engine for that, breaking his investment world down into 3 very distinct categories. Yeah, this is definitely not him just throwing darts at a board. He had a really diversified approach to finding value. Generals were his classic undervalued stocks. Workouts were these special situations that didn't really care what the market was doing. And controls, well, that's where he got his hands dirty. Each category behaved differently, which gave his whole partnership a ton of stability. First up, you've got the generals. You can think of these as his bread and butter, just plain old buying cheap stocks. It's the classic bargain hunter's play. Find good businesses that are just temporarily out of favor with the market. Now, he admitted these could totally go down if the market went down, but because he bought them at such a huge discount, he was confident they'd win out over time. Next, we have the workouts. And these things were just genius, because their success had almost nothing to do with the stock market. See, a merger or a company liquidation, that's going to happen whether the Dow is up 20% or down 20%. This gave him predictable, steady returns and basically acted as an anchor for the portfolio, especially in the bad years. And finally, we get to the most hands-on category, the controls. Now, this is where Buffett wasn't just a passenger on the bus, he got in the driver's seat. He would buy enough of a company to actually influence management and, well, force them to unlock the value he saw buried in there. This took a lot of patience, but the potential returns were just incredible. And to really see just how powerful this control strategy could be, we have to look at an absolute masterclass he pulled off back in 1962, the turnaround of the Dempster Mill Manufacturing Company. So here's the setup. Buffett's partnership buys control of this sleepy, super inefficient company. It had a bunch of assets, sure, but they weren't making any money. To most investors, it looked like a total dud, but to Buffett, it looked like a pile of cash just trapped inside a poorly run business. So what happens? Well, after trying to work with the old management, Buffett brings in this new guy, a turnaround artist named Harry Bottle. And bam, the change was immediate and it was dramatic. Bottle started selling off dead inventory, he shut down unprofitable locations, and he turned all those stagnant assets into cold, hard cash. He wasn't just trimming the fat, he was performing corporate surgery. And here is the result. In just 1 year, the real asset value per share jumped by almost 50%. This value wasn't created because the stock market went up, it was literally unlocked by smart, active management. Buffett bought a business for way less than its parts were worth and then put someone in charge who could actually turn those parts into cash.
Now that Dempster story is incredible, right? But it was just one part of this bigger machine. When you combine all three of those strategies, the generals, the workouts, and the controls, the results over time were, well, just stunning. This is the payoff. Just look at this table. The key here isn't just that his partners did well, it's when they did well. Look at 1957. The Dow loses over 8%, but the partnership is up over 9%. In 1960, the Dow is down 6%, but the partnership is up over 18%. His margin of safety, plus that stability from the workouts, gave them incredible protection when things got ugly. And when you let those results compound over time, well, that gap becomes a canyon. Over these 6 years, the Dow produced a pretty respectable 8.3% a year. But Buffett's partners? They saw their money grow at over 21% per year. That's not just beating the market, that's lapping it multiple times.
And this is the cumulative result. An investment in the general stock market grew by about 62%. That very same investment with Buffett grew over 215%. This is the raw power of consistent outperformance, and it was all built on that simple principle of winning by not losing. And this is the so what. This is why all that hard work for a few extra percentage points matters so much. Buffett literally showed his partners this kind of table. You see, the gap between a 10% return and a 15% return over 30 years isn't just a few extra dollars. It's the difference between 1.7 million and 6.6 million. That few percentage points advantage is the absolute key to creating life-changing generational wealth.
So the lesson from this 1963 playbook is really timeless. Lasting success in investing doesn't come from predicting the future. It comes from a disciplined philosophy, setting clear rules, demanding a margin of safety, and just relentlessly hunting for value where other people aren't looking. Which, of course, leaves all of us with a pretty powerful question. Buffett showed the power of a few extra percentage points. Where will you find yours?